They're waiting to invest and they're scared of the market conditions today, or the market took a huge hit and I'm going to go to cash.
Their fear of loss.
Yeah. When you invest, let the money do what it's going to do. It's going to go up and it's going to go down.
They're watching something. They're seeing some sort of headline. They're seeing, the world is over.
You take that 10,000, you put it in 2004 and you just leave it. Look at the balance. You're seeing that it's
each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
This is John Smallwood, and we are back on Money Isn't, and I have Rob Marks on again. Welcome back, Rob.
Thank you.
Now, for those of you that are listening to the first time, Rob is a wealth advisor at Smallwood Wealth Management. He's been with me since 2017, came as an intern, and joined the firm when he graduated University of Delaware in 2019. He's a certified financial planner. He's licensed, fully licensed in Series 7, Series 66,
Yep.
And a life and health license, and a certified financial planner.
Yep. Certified financial planner, cherry on top.
Welcome.
Thank you.
So I wanted to talk today, you wanted to talk today, because you brought this slide up, not me, about the impact of being out of the market. What causes you to want to discuss this?
So you have a lot of people who it's two barriers. Either they're waiting to invest and they're scared of the market conditions today, or we also get people who see, the market took a huge hit and I'm going to go to cash because I need to see it grow again before I can trust it.
Yeah, the crystal ball.
Yeah.
Oh, it's going to go to hell. This is not a good thing. This is not good. So I want to go to cash. So what are we talking about here today?
So basically what we're talking about here is that instead of kind of dipping in and out of the market and trying to be strategic of, I'll put money back in next month when it looks like things are picking up. The fact of, I don't want to say set it and forget it, but just when you invest, let the money do what it's going to do. It's going to go up and it's going to go down, but about not worrying about that the down market hit and I need to go to cash because I'm scared it's going to go down even more. Right. Because now
let's call it market timing.
Yeah. Because now not only you're basically tapping out when you're at a loss, you now have to, as the individual, have to figure out, when am I investing? When am I putting back in? You now need a crystal ball to tell you when this is going up. And if you do it too late, you're going to miss out on all of that return that can bring you back to where you were.
Right. So people have this sense of, I want to get out of the market. I want to go to cash, despite having cash already, despite having all the proper balance in a plan. They're a fear of loss. Yeah. Because they're watching something. They're seeing some sort of headline. They're seeing, the world is over. It's the psychology of wanting to go to cash because it feels better. But the reality is, if you truly understand what's going on in this slide produced by JP Morgan Guide to Retirement, you understand that missing 10, 20, 30, 40, 50, or 60 days. What's the time period on this? Investing from January 1st, 2004
to 23.
Okay. So how many years is that? We've got...
So it's a 20-year.
It's a 20-year. So a 20-year time frame. Okay. So tell me the story here.
So basically what this is saying is that if you just stay fully invested, I'm not going to touch the funds that are in here. I'm just going to let it, it's going to go up and down. I'm just going to let it do its thing.
So it's a $10,000 investment in January 1st of 2004.
Right. And so you take that 10,000, you put it in 2004 and you just leave it and you check the balance in 2023. You haven't checked the login in 20 years. You forgot password, had to reset. You look at the balance and you're seeing that it's about 63,000. So annualized 9.7% return. Right.
So 10,000, you wake up and it's 63,000 20 years later.
Yeah.
You're super happy. Maybe.
Now, let's take this perspective on it. You look at the account every day, you get nervous of seeing that the market's going to go down or it is going down and you keep taking out. And all you do is you're invested except for the best 10 days in the market, which you don't know. No one knows, right?
During that 20-year period.
During that 20-year period.
You just missed 10 days out of the, how many days are in the 20 years? 365. That's big math. I can't do that. I'm just joking. But it is, we're talking about a lot of days. You just missed 10 days.
That's it. The 10 best days.
What happens?
Your return is almost cut in half. Instead of having about 63,000 in your account, you have just shy of 30,000. And you missed 10 days out of a 20-year period. 10 best days. That's it.
Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. I decided to be out of the market for 10 days over that period. So every 2 years, I decided to go to cash. Or who knows, like whatever those 10 best days are, which I don't know. Like if you look at the headlines over the last 36 months, we've had some of the worst days. We've had followed up by some of the best days, right? Like, and how many people stop funding their 401ks during the pandemic? Stop saving because it was, who knows what's going to happen.
Yeah.
So keep going on this thing.
So, and even if you look, like as you go through, I missed 20 days or 30 days, it keeps inching down. You actually, if you miss the 40 best days in the market for the S&P 500, now you're actually getting a negative return on here.
Yeah.
And remind you, it's, let's say in the missed, 40 days, it's down a little over 1%. That doesn't mean that you didn't have any positive return and any of the other days, but you missed the 40 best performing days,
which were the recovering days, the recovering days.
Yeah. And even if you look into the chart further where they say 7 of the 10 best days occurred within 2 weeks of the 10 worst days. So what's happening is the worst day happens. Oh my God, I'm going to cash. You're still scared of the market a week or two later, right? But the recovery already happened. And now when you go to plug back in, you've missed that whole recovery that would have set you back closer to where you were.
Yeah. And I think you got to flip the switch on this too, right? Because when we start, my thing is I have to, as a wealth advisor, you have to manage the client expectations. You have to make them comfortable with market volatility. So if you think about this $10,000 for a second, somebody's going to be nervous about it if it's their only $10,000, right? So if you said, take 2,000, leave it in the cash and put 8,000 in the market. Now I got a shock absorber. I got a $2,000 shock absorber.
Yeah.
Like I have liquidity. I have what I need. Those short-term needs are, you're pushing now towards that overall return. You're way above the 5.5% return mathematically, like 80%, you're getting 80% of that. You're way above that because your cash has been going up at a nice number also.
Right. You have that buffer and you have that little bit of comfort to say that it's not all gone. If the market's going down, it's not a $0 account.
Right. So the message that I wanted people to get out of this conversation today, and I think the message that you wanted, is market volatility's situation normal, right? But in order for you to be successful with it, you have to orchestrate your plan so that you have the confidence to go through these things, right? And what's interesting to me is it never, like when the reasons to go to cash are historical fear-based. And when you look at the history overcomes it. But I'm not looking at that because it's different this time and it's going to get really ugly. And the reality is there's one standard deviation, one derivative that basically goes out into the future, and the future is an ugly future, right? There's that possibility, right? But if that's the possibility, it doesn't really matter what you did.
There's a lot more things going on.
There's a lot more things, right? But if things stay as if they've stayed for the last 100 years in this country, good times followed by bad times, followed by good times, followed by good times, followed by bad times, followed by, all kinds of crises. But the trend is always moving forward. We're growing. We're growing as a country. We're growing as a community. Our populations are growing. Our technology is growing. Our life extension is growing. Like, you need confidence in your plan. And you have to read this chart and say, if this is the role of the money, because money has a role. Money isn't everything, right? Money isn't podcast, but money has a role in your plan. If the money's playing the wrong role, then you're missing the opportunities, right? So like, how many people have we encountered where they have the majority of their retirement plan, the 401k, which is money that's 25 and 30 years out in front, it's all in cash.
Oh, a lot. I mean, it's like, it's incredible too, because it's like, I'm going to store this money in here. There's potentially a tax advantage piece of this, depending on how you're doing it, right? And you don't take advantage of the tax for growth. It's just like, oh, I'll build the cash.
Yeah, or that long-term investment is the role of the money is long-term, but the investment is short-term. That doesn't make any sense.
No.
You've got the money's in the strategy's in the wrong place, right? So part of what I want people to really gather from this is you have to look at what's the role of this money. You really hit it. You hit something that really is a really smart thing. Like, there might be a tax advantage in deferral, right? And what is that? What might happen? What is the role of tax deferral? Right.
So when you have a 401k, just for listeners who are a little bit newer to this, like, you generally have two options. You would be a pre-tax contribution. So money comes right out of your paycheck. It's not taxed. It goes in the account, and it can grow tax deferred, meaning that going in and out of things, there's no taxation along the way. But when you go to pull the money out is when you get taxed. Now, you also generally have a Roth option, which is basically the same thing, kind of in reverse.
Pay the tax.
Instead,
now.
you pay the tax today. You still don't pay any taxes as the growth that's going on in the account. And when you pull it, it's tax-free. Now, the problem that a lot of people have is, I don't want to pay the tax now. My taxes are out of control as it is. I'm going to do pre-tax. And they do pre-tax from when they start their 401k until they retire.
Yep.
And the problem is that they don't look at the other side of the math, which is, am I paying more tax today? Or do I think when I'm retired and pulling this out, I'm going to be paying more tax? And everyone, again, they kick the bucket down the road. And what you've seen, as well as I have, is people build up these plans that they go, great, I have $1 million in my 401k. And it's, well, you also have a tax liability of, $200,000, $300,000 on this thing. And no one thinks about the value of that, right?
Right. So the sole purpose of tax deferral is to take money from a high bracket and defer to a low bracket. Mm-hmm. If I end up in the same bracket or a higher bracket, I probably didn't win.
Yeah.
Right. And if I use this chart of $10,000 and a 30% tax bracket, and I say 10,000 grew to 63,000, okay, mm-hmm. the tax today would have been $3,000 at 30%. Mm-hmm. So if I took $3,000 and compounded it at 9.7%, and I'm in the same 30% tax bracket, it's going to be roughly $19,000 of tax. It's 30% of the account. Yeah. Like, the government was investing side by side with me. They're getting their return. If I go to a higher bracket, I lose. The only way I win is by going to a lower bracket. And that's why the combination of how you approach this has to be unique for the individual.
Yeah. And by the way, too, because, it's missing 10 days or missing 20 days is the expectation of getting in 2004. But what if I waited until 2010 or 2011? I'm still missing those. I may not be invested for the downslope, but I'm also not invested for the upside of this, right? So this is why being not only fully invested, we don't know when the market goes up or down, but we do know if we're in the market and we're in it early and we let it be, on the long term, it should kind of do its thing and have, what we're seeing here, the 9.7 in this case.
Yeah. The message here is you gotta get a plan and know the role of your capital, right? Mm-hmm. Anything else you want to add?
The only thing I would say is just, in addition to being in the market, you also want to make sure that, people are diversified in their investment allocation, but when it comes to their financial plan, they don't have as much diversification. And why is that, right? When you're saving or you're putting money towards things, it's going into all these different silos. Why aren't you making sure that you're diversified, not only in the allocation, but in the strategies for all those different pieces?
Exactly. This was really good. I really appreciate you on today.
Thank you.
This was fantastic. Thank you.